Next concept here. We've done 5. Now we're going to do 6, 7. 6 and 7 together. Okay. Number 6 talks about, now we're adding a new feature in here because now we're looking at it from the seller standpoint and how they handle sales returns and what that does to the inventory and how they take that away from the cost of goods sold and the sales, the total sales. So let's kind of go down there. They sell 2,000 books on account for $19 each. The cost was $22.08. 100 of these books that cost $1,140 were damaged, so they returned them. And then the customer paid the balance on October 22nd, and the credit terms were $220 net 45. So 2% discount in 20 days, and the net was 45 days. So let's kind of sort through this, all right? First of all, we have accounts receivable. We got to record the sales. So they record this, and that's going to be a debit to the accounts receivable and a sales revenue. So your debit to the accounts receivable is going to be 2,000 times $19, so that's $38,000. You're going to have corresponding credit right here. Now the cost of goods sold was what for this? What did it say? It said $22,800, sorry. So I'm increasing my cost of goods sold. I've got to decrease the inventory. Now we have a return, and what does that do to us? What do we have to do? Well, first of all, I've got to figure out the amount, which is $1,900, right? I did something with $1,900. Well, I know it comes out of my accounts receivable, so that becomes a debit, a credit. And I have to create this account called Sales Allowances and Returns to hold that. So when I do the income statement, I will be able to subtract that from my total sales, because that's not a true sales. Now, I'm not done yet because I'm a seller. I also have to do something with my cost of goods sold. If it comes out of my sales, I don't want it showing up in my cost of goods sold. So what was the amount that would be associated with that? So we look at that, and I believe they give you that. You would have to prorate it, otherwise you'd have to go back and do a calculation. They gave us that, so it was $1,140. That has to come out of my cost of goods sold, because that material was returned. I also have to put it back into my inventory to show that my inventory's gone up. Even though they were damaged, I'm going to have to do a different I'll do that at the end of the period, an adjustment for, or the end of the year, an adjustment for damaged goods. But right now, I've got to put it back into inventory. Then they're getting ready to pay it, and now we have to sort this all out. Because, how much is your cash? What is your true amount you're going to get? Well, I started with $3,800, right? $38,000. But then they returned $1,900. So that's what I'm dealing with. Whatever that amount comes up to be. And then they get the discount. And it's a 2% discount. So I can multiply the cash by 0.98 and get the amount I would receive in cash. And that amount, $35,378. Then from there, I have to figure out what goes here. Now, what was left in my accounts receivable? You know, it started out at 38. We subtracted 1,900 from it, correct? So that's going to give me my accounts receivable. My sales discount right here. is going to be the balancing number, or it's going to be 2% times 38,000 minus 1,900. And that will round it out. So again, let's review. Record the sales, record the cost of goods sold. If there's a return, you record the sales return, and then you record the return on the cost of goods sold, and then when you do the cash receipt, you have to subtract the sales return to get the amount to take the discount off. So involved in this is a sales discount, a sales return, and your cost of goods sold. It's very complex, so hang on to it. Remember, you're on the seller side now. Then they ask you the gross sales revenue. So you're going to take your gross sales revenue up here of 38,000, less the sales return, less the discount, to come up with the net sales revenue. And then they want the net sales revenue to get your gross profit. So here's your sales revenue minus the cost of goods sold, by taking the cost of goods sold minus the return right here to give you the gross profit. And that is a full cycle, okay, of just one item being sold. Let's look at, where the heck is it? 8, right here. 8's a real quick, interesting one. This is what will be an example of when you get to the end of the year, you're doing your full financials, and you go out and you look at the inventory, and the inventory shows 68,000, but you only have a physical count of 66,700. And you have to adjust that. This would be an example of what to do with that damaged goods that was returned. This is where this would show up. And they're asking you, how would you adjust that account? Well, first of all, you would add the cost of goods sold. That would go into the cost of goods sold. And the difference between the 68,000 and the 66,700, that gets added to the cost of goods sold and subtracted from inventory. You would make a notation here of damaged goods, lost goods, or stolen goods, and as an adjustment. So a very simple entry you would make at the end of the period as you were doing all of the final bookwork. So I think we'll end this one, and then we'll start with number 9, which looks at closing entries, which can be confusing. So